Welcome back to Storm Stock Solutions. I'm Grant Mercer. Let's set the table for the trading day ahead and bring a little clarity to the chaos before that opening bell rings. We're coming into this session with the market camped right on the doorstep of record territory. According to reporting from MarketWatch, all three major U.S. indexes logged back-to-back gains yesterday after November's private sector hiring data came in weaker than expected. Normally, soft jobs data might rattle investors. This time, the street chose to see the good news and bad news, using it to firm up expectations that the Federal Reserve could deliver a quarter-point rate cut as soon as next week. That's the key macro driver this morning. The market is leaning into a Goldilocks narrative. Growth cooling just enough to give the Fed cover to ease, without signaling a hard economic landing. As long as that story holds, dips tend to get bought and traders are comfortable pushing indices toward new highs. But keep in mind, a lot of that optimism is now priced into expectations. Surprises in upcoming labor or inflation data can flip this tone quickly. On the opportunity side, strength continues to cluster around tech and I-linked names, but with nuance. Salesforce was a standout after earnings. As MarketWatch highlights, the company is talking up a powerful pipeline of future revenue and leaning hard into its AI momentum. The stock zoomed higher, and traders are watching whether this is the kind of print that can shift what's been a pretty skeptical sentiment backdrop into something more constructive, at least for a while. More broadly, it underscores that for software and cloud players, the bar is now show me AI-driven growth, not just talk about AI on the conference call. We're also seeing pockets of strength in payments and semis. Observe, one of the S&P 500's weakest performers this year, popped after two top executives put about $1.5 million of their own money into the stock, according to Emily Berry's reporting. Insider buying doesn't guarantee a turnaround, but it's the kind of signal that often gets professionals to take a second look at beaten-down names. And in the chip space, Marvell shares are on the rise after issuing an upbeat forecast and laying out a path to big opportunities in data center and networking. At the same time, analysts are still asking tough questions about its competitive positioning and the impact of a new deal. So that story is strong but still under review by the street. On the flip side, there are areas to handle with care, especially within high-expectation AI software. That same Salesforce rally that looks so powerful also highlights a risk. When expectations get reset higher overnight, the margin for error shrinks. MarketWatch notes that a critical question is whether this AI-driven enthusiasm can actually sustain a longer-term turn in sentiment, or if it becomes another short-lived pop in a choppy tape for enterprise software. We're seeing similar fragility in other AI-linked names. Snowflake, for example, beat on earnings, but its stock struggled because growth in product revenue slowed, and the shares have already outperformed peers this year. When a stock has run hard, good often isn't good enough. That's a recurring theme professionals are watching. Multiple AI names are being rewarded only for clear acceleration and punished for anything that looks like deceleration. Outside of tech, one sector to monitor with some caution is airlines. Delta disclosed that it will take a financial hit from shutdown-related flight cancellations. The interesting twist, as Claudia Assasat at MarketWatch points out, is that Wall Street actually seemed relieved. Demand for the December quarter remains healthy, and the cost of the disruption wasn't as bad as feared. So the sector isn't flashing outright red, but it's still an area where operational headlines and macro travel trends can quickly swing sentiment. Let's talk sleepers. The under-the-radar stories I'm watching in the background that could matter more if conditions line up. One big one is power for AI. Jurika Dujmovic at MarketWatch highlights that AI's explosive growth is running headfirst into an energy bottleneck. Data centers, chip makers, and the broader AI ecosystem need massive amounts of electricity, and there is a shortage in certain regions. The piece frames it as a lucrative but potentially brief window for companies positioned on the right side of that power crunch. Utilities with data center exposure, grid and transmission players, and specialized infrastructure names. It's not a buy or sell call, but it is a structural theme that many institutional desks are now modeling into their AI playbooks. Another sleeper is the tone around mega-cap AI platforms like Microsoft. Brittany Nguyen's reporting notes that Microsoft shares dipped on reports of AI sales challenges and adjusted quotas. Some analysts are already calling the pullback a potential opportunity, arguing those quota changes early in the fiscal year aren't that surprising. What the pros will be watching is whether this is just noise in a very fast-changing AI product cycle, or an early signal that enterprise customers are becoming more selective on AI spend? That answer will matter not just for Microsoft, but for sentiment across the entire AI complex. Layered on top of all, this is policy risk. Robert Schroeder at MarketWatch details former President Trump's push to roll back fuel efficiency standards from a roughly 50 miles per gallon trajectory under Biden-Kara rules down to about 34.5 miles per gallon. The article makes the case this won't suddenly make cars cheaper, but it does create another moving piece for automakers, EV suppliers, and the broader auto value chain. Traders may not trade this headline tick for tick today, but it's part of the longer in-term regulatory backdrop that can shape capital spending and product roadmaps in the sector. So putting it all together as we head toward the opening bell, indices are starting the day with the wind at their backs, thanks to rate cut hopes tied to softer hiring data. Areas showing strength include AI-enabled software, selective semis, and turnaround speculation stories like Pfizer. Areas that look fragile are high-expectation AI names where growth is slowing, and cyclical groups like airlines that remain sensitive to operational shocks, even when the immediate read-through isn't as bad as feared. In the background, Power 4i and evolving auto regulations are quietly reshaping the landscape. We'll be back with intraday updates once the market is open, tracking whether this push toward record territory has enough fuel to keep going, or if profit-taking sets in. Remember, this is information and education, not personalized financial advice. As always, I'll be here to keep clarity through the chaos of these markets. On behalf of Storm Stock Solutions, I'm Grant Mercer. Stay sharp, stay steady.